Hello, everyone. Welcome back to another episode of Let's Talk Housing. My name is Brennan Thomas, and I am the co host alongside the Stephen Thomas, chief economist and founder of Reports on Housing. Today, we will discuss the most recent economic news and some real estate statistics, the recent inventory surge, first time homebuyers depleting, the state of the job market, and more. But first, Stephen, like usual, what is going on in your household? Where have you been? You've been missing.
That's right. I have been. And thank you for pinch hitting. He did his first housing debrief pinch hit for me on the our YouTube channel. And we do a weekly thing. I didn't do anything while I was gone, but it's time for somebody to step up and hit a home run, which he did. So great job, by the way. So where did we go? We went to we were in Idaho, in eastern Idaho, where we were able to travel a little bit above Idaho Falls, where we were able to travel to Yellowstone. We went twice, woke up at the crack of dawn to beat the crowds and hit some of the most touristy spots before everyone else did. And then toured over to the Grand Tetons, and we flew into Jackson Hole, and so we played around in Jackson Hole as well for a day. So it was fun. We had an absolute blast. Now we're back in the saddle. I'm totally refreshed. I actually unplugged from most economic news. There was just bits and pieces that I followed, but wasn't looking at the 10-year Treasury on a daily basis or anything like that. So that's what we did. Totally refreshed, ready to go. Came back to a lot warmer weather than what we left behind, but not as dry either. Enjoying being back in beautiful Southern California. Anyways, that's what's going on for us. How about you, Brennan? What's going on with you?
Yeah, like you said, I mean, took over the debrief. That was a fun little thing to cover, especially for the first time, but something that was really interesting. And it was fun to sort of record and have my little hiccups in there and just re-record and stuff, but it turned out great and I was happy about it. And it honestly just gives me a different insight as to like what's actually happening. So, I mean, of course, whatever you're covering, you have to learn a little bit more about what you're actually teaching, and it was a fun little thing to sort of get going. But other than that, I have like a few things I'm looking forward to with like concerts coming up and a trip. I'm going to be in Seattle in August, so a bunch of fun things coming. So I am ecstatic for that. But what has happened over the past couple of weeks with the real estate market while you've been gone? What did you catch up on?
Yeah, when I looked at all the differences in active inventory and demand, what was interesting is there was a definite tariff effect to demand. And it happened once tariffs were announced. You actually saw it with volatility of stock market. So you saw it all in all different ranges, including luxury. Luxury was with the volatility in the stock market, and rates actually rose a little bit during that time period. We were hovering right around 6.75. Now we've been hovering right around 7%. So you can add a little bit more higher interest rates. So that was the net effect of that. But what we saw was demand actually came down during that time period, even though with rates going up a bit, they were lower than where they were last year. Last year, we hit 7.5% in the month of April. So even getting right at 7% was lower than where we were last April. So as a result, we had this diminished demand, and now I'm coming back, and demand has come back to where the last couple of years, and interest rates are very, very comparable to where they were last year at this time. We're right where we kind of were last year. Demand's the same, has not changed really much in the last 2 years. This is the third year in a row of almost identical demand in almost all markets. There are some outliers, but that's predominantly what we're looking at. And when I'm saying there's outliers, most of the outliers are a little bit less. So that's why when you look across the United States, the number of closed sales are just a little bit less. It's nothing catastrophic. It's just a little bit less. But overall, we're in most markets looking about the same year over year. And so there's not much of a change that we're seeing yet. We need rates to come down a lot more. So that's kind of what's going on. So the speed of the market right now, what we're going to see is inventory continuing to rise slowly as demand goes down slowly. It's not going to go up at the rate inventory that it did before, but still, even with inventory going up slowly and demand going down ever so slightly, because this is summer, second fiddle to the spring. What we'll ultimately see is the market slows from week to week, just a little bit, but over time, over like a couple month period of time, you're adding extra days, maybe a week to the speed of the market. So it takes an extra week longer to sell a house. So when do you want to come on? As soon as you can. When do you want to be priced right? Now. You don't want to be reducing the price into a slowing market down the road. So that's kind of where we're at right now.
So you touched on rates, but actually yesterday, June 18th, there was a Federal Reserve press conference, which got a whole bunch of reactions. So what happened there, and what happened with the economy over the past couple of weeks?
Yeah, pretty much what we expected, a big nothing burger. They didn't do anything, and that was the expectations. If you go on to CNBC, you can see a bunch of talking heads, a lot of really intellectual economists, as well as former Fed members, and they were all saying the same thing. They can't. There's really no reason for them to cut rates right now. Looking at the expectations of inflation down the road are elevated, and the job market is sound right now. Although job readings underneath of the hood kind of look like that there are some things that are worth watching, and the participation rate in employment really went down significantly, and that was what they're thinking that is those are the Doge cuts. They don't actually show in unemployment or anything like that, not until September, because they're still on the balance sheets because they're paying out on a monthly basis all the way through the month of August. It won't hit till September, which we won't have a reading for that until October. So that's to come, but we're seeing it in other aspects of it. So overall, that's the Fed decided just to punt, and we're going to wait and see. And there's some really good sound bites from Jerome Powell, basically just stating that specific thing, that there's nothing breaking in the labor market. This is this wait and see. We're watching all the data really closely, and that's what they do. They're very, very data dependent, because we're kind of in a place right now with so many different presidential administration policies going all at once. And now we have some other developments around the world that will have an economic impact. So as a result, it's kind of like a wait and see, okay, which shoe is going to drop? And that's really where we're at.
Yeah, and you and I talked about that recently, saying how this tune just reminds us both, or at least me, of last year, where it was sort of like the wait and see feeling, and then it was all the way in September when some people were saying, "Oh, we're not getting rate cuts anytime soon." That's when they actually decided to cut rates, and it seems like that sort of theme is just going to blend over into this year. Um, but that's okay. We'll just have to play it by ear and hope that something can show up where they can actually maybe get a little ahead of the ball, ahead of the curve. But do we still have a low level of inventory? Because that has been another topic of this year. Is this the housing shortage, or is the shortage still a thing nowadays with our developing inventory trends?
Yeah, we we still do have a low inventory. The low inventory, if you look at where we were during the Great Recession, even prior to the Great Recession, we had an elevated number of homes on the market. And coming from during the Great Recession, having 4 million homes on the market, and right now having 1,450,000 homes on the market across the United States, according to National Association Realtors statistics, which are aggregated from all listings across the U.S. So at 1,450,000, we're missing a lot of homes. But it's bringing us, and you can see that it's going to bring us closer to the levels of where we were prior to the pandemic, which is closer to 2 million homes on the market. So we're going to get there, and we'll be. That's still a low inventory, and you could actually see a downward slope from 2012 to 2020 prior to the pandemic, a downward slope in year-over-year inventory. So inventory levels were slowly diminishing over time. So the fact that we're getting to where we were pre-pandemic. That was still really low compared to even where we were in 2012. It made its way down there. So as a result, still a low inventory. It's just not what we have seen during the pandemic. So we've got that extra cushion of extra homes, and what that these homes were, so we're almost at pre-pandemic levels. What it's being matched up against is very, very low muted demand, and that low muted demand is very similar to like what we experienced during the Great Recession. But the difference is there are 4 million homes on the market versus right now 1.5 million homes on the market. And you match that up against the demand. And that's why we still have been able to realize some price gains across the United States. But that's slowly coming to an end.
Yeah. And so something similar that I wanted to touch on was how, according to Redfin, they came out saying these two things over the past couple of weeks. They said housing market bubble could deflate this year, and that the US housing market has nearly 500,000 more sellers than buyers, the most on record. And of course, that sounds like an alarming thing, but are these sort of headlines misleading, or would you say they are accurate?
Well, I think the first one, it refers to it as a bubble. And the only thing that happened was we've actually talked about it. It's kind of like a bubble where it was inflated by the Fed, ratcheting up rates as much as they did, going from 3.25 to over 7% in mortgage rates in such a short period of time. That's from January of 2022 to October of 2022. That is a gargantuan leap, and it's unlike any kind of leap that we've had before, because if we're at 3 and you go all the way up towards 7, that's more than doubling of the rates. So as a result of more than doubling of the rates, it really slowed down the overall market completely, and that is that buildup of unaffordability. So there's not that many people that can participate. So what they're actually referring to, and that was just one of those smoke and mirror clickbait headlines, and then you can dive into the more meaty part. Just saying it's a bubble and the air is coming out makes it sounding like it's going to implode. If you're referring to the air coming out of it, it's more like a pinhole, and that's about it. If you put a pinhole in a basketball, air is going to leak out, but at a very, very slow rate, and it's not going to deflate completely. What's going on right now is we have had interest rates that have been stuck at 7%. And they've been there for, if you look at the overarching theme is it's been pretty much 7% it's going to be close to 3 years. So being at that same demand level or interest rate level for such a long period of time, at first, nobody came on the market in 2023. And then in 2024, more homes came on the market and more sellers participated. So there was more signs in yards across the United States. Those extra signs in 2024, they were matched up against very similar to demand as 2023. Yet the big difference is they accumulated in 2024. There was an accumulation of homes because the demand level had not changed. Interest rates had not changed. So as a result, we saw this accumulation of the inventory and the supply rose. And in 2025, even more homeowners are participating. So there's even more for sale signs hammered into the yards. And as a result, we're getting more of an accumulation. So what's really going on is we have a lot more homes on the market, that very similar demand. And it's at the point now where we're past spring, almost the halfway point of the year. And at the halfway point of the year, we're into July. There's not that much room for summer market. Our summer ends at the end of August. And that's where September 1st, all the kids are back to school. A lot of people are done with their vacations and things like that. So as a result, the demand levels start to fall. Typically supply falls, but it hasn't over the last several years because of higher rates. And as a result, what we're going to get the second half of the year is you're going to see if inventories don't peak out until later on in the fall and demand continues to come down, it's only going to get slower. And the markets are already sluggish with this extra inventory. So that extra inventory is going to provide more pressure. And the people that really do want to sell will ultimately price their homes to better sell. But this is not the Great Recession. Everybody needs to understand that nobody is sitting out there with all this equity and they're ready to give away their equity. That's different than the Great Recession where banks were in charge. People had no equity in their homes. They walked away from homes. They did short sales, foreclosures. And as a result, the banks, they had to unload it. They had to unload it. These are different sellers today. There are some people that have to unload it, but they're the exception, not the rule. So most people would like to move. And when you would like to move, you are not ready to just flush away a lot of equity. So as a result, you'll look at most recent comps. And if you're into the end of summer, into the beginning of fall, you might take a few $1,000s less than your neighbor that sold during the spring. And as a result, that means that they're taking a few $1,000s less. Over time, that aggregate becomes like very low single digits, down 1%. And that's what Redfin actually stated, is that they would be down 1% by the end of the year. 1%. You do the math on that. On a $500,000 home, that's down what? $5,000. So it's exactly what I said. A couple $1,000s here, a couple $1,000s there. You're from 500 to 495. This is not anything where it's from 500 down to 350. Let's get in. That's not what we're anticipating. There's a real stickiness to pricing, and it's not going to all of a sudden crash. There is no recipe for crash. You need a lot of extra homes, and you need a lot of people in pickles in some precarious spots that they have to sell, and they'll do whatever it takes to get it sold. That's not going to happen.
Steve, your major concern is how when rates drop, demand will surge and therefore prices will too. So with inventory climbing even higher and higher since 2022, could there be enough of a cushion for home prices not to surge like you've been suggesting?
Yes. The extra homes coming on the market is actually the silver lining to interest rates being stuck at 7%. The longer they remain at 7%, the more of that cushion that we will develop. And it will never get up to the point where we have 4 million homes on the market, because we're about to peak out for this year. And then they'll come down. When I say about to peak out, in many markets between July and August, it peaks. Later on for the United States, it's closer to September. It's been longer in more recent years. But even though we're not going to get that same gains that we did before, so what you see is we're gonna slowly rise, and then it'll come down for the rest of the year. But what those extra homes will, that accumulation of homes will, that'll be that extra cushion that will prevent home values from accelerating very, very rapidly. But I still have my concerns, because I've talked about it before, that we've been stuck at 7% for such a very, very long time, that once we get just down to 6%, the levels that get the hottest are the ones where they require mortgages, right? And well, everybody gets their mortgages from all different price ranges, but especially the people that are in the entry level price ranges. And everybody knows their entry level price range, and it is the hottest price range for detached homes. So that is the one where the longer we stay at 7% or 6% with duration, and it's just getting to 6%. We used to say down into the fives, but we've been stuck now for 34 months above 6%. So we haven't seen fives since August of 2022. So as a result, just being down to 6%, we were down there for 47 glorious days in September, and we saw this surge in demand, and then it stopped. We went all the way above 7% again in October. So we were there for a short period of time. And if you can imagine being stuck at 6% for duration, when I say duration, let's say that like this year, you could have 6 months where it's hovering right around 6%. That will create enough inventory that cushion will be easily eaten in the entry level ranges, and then we can see that acceleration in prices, which is why I've always said it is a good time to buy. Right now is a great time to buy, and the reason for that is because rates are relatively the same as where they were last year, but there are a lot more options versus what I'm referring to is a lot more competition for homes, and it will be easily eaten up the longer we stay at those lower interest rates.
So CBS News said that first-time homebuyers are an endangered species in the US. Figures from the National Association of Realtors show that only 24% of housing sales last year were by first-time homebuyers. That's down from 50%. So with today being considered one of the most difficult job markets for newly grads, What type of effect will that have for first-time home buyers down the line?
Yeah, I remember prior to doing this, when I saw the 50%, I go, when was it 50%? And that is the biggest asterisk they could possibly compare it to. That was when we figured it out. When was it, Brennan?
2000.
Thank you. 2010. That was during a first-time home buyer tax credit of up to $8,000, which instigated a lot of first-time home buyer activity. So there was a tremendous amount of first-time home buyer activity that occurred that year, and it was because of that first-time home buyer tax credit of up to $8,000. So as a result, there was this wave. So yes, 24% is still really low compared to where it typically hangs out. But 50% makes it sound like, oh my gosh, usually half of all buyers are first-time home buyers. That's just absolutely not true. That you'd be kidding yourself. It's closer towards 30% than it is to 50%. So yes, it's down. This will only improve once rates come down. But we've said it before, when you are stuck at these higher levels, who's participating? It's a lot of the homeowners with a lot of equity. They can afford to downsize because they have a lot of equity, and then they can go buy something else. And they could place a lot more cash at it, so that their interest rate, their loan amount is a lot less, so that they're not facing what some of these first-time home buyers are facing. And first-time home buyers, a lot of them opt to use FHA financing, which is 3.5% down. So they don't have a lot down, but they have a lot more that they have to get. They got to get a much higher loan, so their loan balance is higher. And now they got interest rate, that the higher interest rate, and they're paying mortgage insurance on top of it, MI. So their payments are going to be a lot more cost prohibitive. So as a result, because of affordability, what we've all talked about, first-time homebuyer activity has dwindled down towards 24%. And that's kind of where it's at right now. And a lot of that 24% is made up of people that are high income earners, even though it's their first time buying, and their dual household incomes. So there's a lot that goes into that statistic. There's a lot of help from relatives that are helping them get into a house. So that makes up all that 24%. Because remember, very, very low number of home sales across the United States. As this elevates, it's only going to elevate once we have better interest rates. Then we'll get an elevation in the number of closed sales, which will be an elevation in the number of first-time home buyers as well. And that percentage should rise at that time.
So we talked on sort of the negative spin of first-time home buyers, but on the contrary, other than when rates were at the lowest on record, is this the best time for a first-time buyer with so much inventory and tighter home prices now that they're slightly declining month over month?
Yeah, I wouldn't be sitting on my heels waiting for values to come down a lot, because I just explained. The difference in financing that $5,000 is not that much if you're waiting for it to go down 1% by year's end. That's not, and then you're going to be matched up in a spring market, and spring in almost all markets that are slightly down, it will be up during the spring market. So what you got to be really careful, because down the road we could get those interest rates. There are many paths to getting down towards 6%. There are very, very, very few paths to rates rising and skyrocketing towards 8%, or what all the doomers and gloomers are talking about. The pathway just doesn't exist, because what people are looking at is how the economy is only going to slow from here based upon everything that's going on. So as a result, down the road, we just don't know when we're going to get more relaxed rates. So when we get more relaxed rates, that's where things will ultimately change. So when do I want to play? I want to play when it's kind of like the Warren Buffett thing. You want to play when nobody else is, when you want to go buy when everybody else says you shouldn't be buying right now. That's typically when to buy, because it's not when you try to buy when everybody else is buying, because everybody else is buying it. It makes it very difficult to purchase at that time period, and it will prove not to be the absolute best time. Timing is really, really hard. I want to get in when I know that there is not a lot of competition. That's what I did when I purchased my last house. I did it in the fall of 2019. Not a lot of activity back then. And this is very similar kind of a marketplace that we're in right now that people don't remember, but that's what we're dealing with right now. So it is a very lucrative time, because even if values go down a little bit, we're talking just low single digit. So a low single digit, like 1%. In some markets, it's maybe 2%. And everybody knows where that is in the country. That's where we get a lot of the comments from. What about over here in Florida? All right, come on. Seriously, Florida is not the United States of America. We're talking the United States of America as a whole, for Pete's sake.
To some people, it is.
Yeah, seriously. Whatever happens in Florida is going to happen in the rest of the United States, right?
Yeah, seriously. But builder confidence in the market for newly built single family homes was 32 in June, down 2 points from May, according to the National Association of Home Builders Wells Fargo Housing Market Index released a couple days ago, if not last week. Third lowest reading since 2012. What is this an indicator of?
This is an indicator that home builders are not too happy with their accumulating inventory. So what's happened is new homes. We had a very, very, very low supply during the COVID years, and even in 2023, super low supply. Started to build it in 2024. Now there's a lot larger supply of homes. Now, builders were the only ones that could control the destiny of supply, and they could build. So they could build when supply was really low. So they were the only alternative out there when they didn't have the alternative of actually going down the street and buying a residential resale, because very few were available. Now, competition in residential resale has emerged, and as a result, for new home builders, competition, as well as a lot of what they were building all came to market at the same time. There was this big delay because of all the different supply chain problems. And as a result, here we are. They are now competing against more homes on the market. So there's more competition. So there are more opportunities for buyers to look at new and residential resale. And then we have rates that have been stuck high for such a long period of time. That is also a bit of a bummer on this index, where they're saying interest rates are too high. I think a builder came out today. Here we are recording this on Thursday, June 19th. And one of the builders, I think it was Pulte, said that the Powell should be reducing rates, echoing what the administration is saying at the same time. But they're only saying that because that's what they need. The administration needs it because of all the policies that they're making, but they're not going to do it because that's what the administration wants, because they have a dual mandate. What's their dual mandate? It's maximum employment, which we have, and inflation under check, which is a question mark. So that's why they're staying pat. The builders want it because why? It will fuel more home sales for them, which will help their stock. That's not going to push things, but that's actually why they're all a little bit upset, because they would like rates to come down too, like everybody else would like. And we would like to see rates come down as well, but there has to be a pathway for it to happen. That has been articulated for a very long time with the Fed, not just this administration, the last administration as well. They were saying the same thing. They've been pounding the same drum. We're very, very data dependent. We're very, very data dependent. I've talked about data dependency of the Fed for a long time. This is not new.
So to finish off today's episode, you covered this topic in detail in a housing debrief that was posted fairly recently. So if you haven't seen this before, please go check it out. But is there a debt bubble brewing?
Oh my gosh, seriously. I know a lot of people ask this like as if, oh my gosh, it is going to be the biggest recession of recessions. Everything's going to pop. There is a giant, it's not just housing, because look at all this extra equity that was built up. That's going to pop. And there are so many people across the U.S. citizens across the world that are just carrying way too much debt, from credit card to all that stuff. By the way, that credit card debt, we've been following it all of a sudden. It had gone up, and then it kind of peaked out, and we were watching delinquencies and things like that. That is everybody across the United States, including renters. And the renters are the ones that tend to get in the pickle most. It's the people in the lower income levels, from mid on down to especially the lower, where they have a different debt reading. So if you look at homeowners, just the subclass of homeowners and their debt, they're sitting in a really good spot. Not only is their debt level as households really small, it's also they can also tap into equity if they needed to. And that's not actually going to happen. We're not going to really see that happen. That's not where we're at. We're looking at tappable equity. There's plenty of places for us to go to see who's tapped equity. One of them I recommend everybody. It used to be called Black Knight. It's called ICE, and they do a mortgage monitor every single month. This is all that they do. It's fantastic. It's great to follow because you get every aspect of it. We also quarterly download the National Mortgage Database. There are so many different data points to this, so there's a lot for us to look at. So as far as people looking at where there's some real hiccups in the economy, and this debt thing being one of them, this is just what a lot of these doomers and gloomers have been talking about for a super long time. And then so they're also talking about the United States debt. That's a big thing, that this thing is just going to absolutely implode. It is something that we need to get a handle of, and eventually we absolutely can. But you have to understand, it doesn't mean that anything's going to catastrophically happen. If we were in a real pickle where the debt was a real problem, people wouldn't buy our debt. And our debt, if you look at the 10-year treasury, hasn't been changing much since even we did all this trade, the trade war thing, and with all the tariffs and everything else that's gone on with all this economic, the economic uncertainty index is like off the charts. However, I'd say the 10-year treasury has been pretty tame. And it's been acting the way it should act because the Fed's not going to do anything anytime soon. That's exactly what they said when they met yesterday. They said two for the rest of the year, and it's going to come later on this year is what it looks like. And that's because they have no idea, so they're just keeping everything the same. They had it at 2 in December. They had it at 2 in March. They said 2 for this year yesterday, and it looks like it's going to be, I don't know. Nobody does. So they just keep it at 2 so that it keeps everybody happy, and they're not the ones disrupting the market. So that's where it's at. Let's just call it 2. But there's not really a big debt bubble brewing, because if there was, you would see this economic calamity start to unfold. And we were seeing a bit of it during the tariff initial announcement. A week later, they took off all those tariffs that were just off the charts and brought everybody down to 10%, with the exception of China, and then they brought them down to 30% more recently. So as a result, it's kind of put a lid on the problem of debt and people not wanting our debt. So that's the other side of the equation when they're talking about this debt bubble brewing. That's also not looking like it's anywhere close to popping as well.
Thank you, everyone, again, for tuning into another episode of Let's Talk Housing. If you want to learn about what is going on across Southern California, Bay Area, Phoenix, Las Vegas, or anywhere in general, the US, we have it for you. We will talk about it, whether it's on our YouTube channel or if you want to subscribe today. Go ahead and check out our website, which is www.reportsonhousing.com. Please leave us a good review, and if you have any questions at all, you can post it to any of our social media platforms, or you can email me at brennan@reportsonhousing.com. We will see you soon, and have a great rest of your day. Thank you.
Thank you.